Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Understanding Risk in Financial Markets. Understanding risk in financial markets is a fundamental component of strategic financial planning and aligning business goals. Risk is an inherent characteristic of financial markets, and comprehending its nuances is crucial for making informed investment decisions. Financial risk can be broadly defined as the possibility of losing some or all of the original investment. It arises due to various factors, including market volatility, economic changes, and geopolitical events. To effectively manage risk, it is essential to understand the types of risks, their sources, and the methods used to mitigate them. Market risk, also known as systematic risk, refers to the risk inherent to the entire market or market segment. This type of risk is influenced by macroeconomic factors such as interest rates, inflation, and political instability. For instance, the global financial crisis of 2008 resulted in a significant downturn in financial markets worldwide, illustrating the impact of systemic risk. Unlike unsystematic risk, which is specific to a particular company or industry, market risk cannot be eliminated through diversification alone. Therefore, investors must employ other risk management strategies, such as hedging and asset allocation, to mitigate the impact of market risk. Credit risk, also known as default risk, arises when a borrower fails to meet their debt obligations. This type of risk is particularly relevant in bond markets and loan portfolios. Credit risk assessment involves evaluating the creditworthiness of borrowers through credit ratings and financial statements. The collapse of Lehman Brothers in 2008 is a stark example of credit risk, where the failure of a single institution had widespread repercussions on the financial system. Credit risk can be managed through diversification of credit exposure, maintaining stringent credit standards, and using credit derivatives such as credit default swaps. Liquidity risk refers to the risk that an entity may not be able to meet its short-term financial obligations due to an inability to convert assets into cash without a significant loss in value. This risk is prevalent in markets with low trading volumes or in times of financial stress. The liquidity crisis faced by Bear Stearns in 2008 exemplifies the severe consequences of liquidity risk. Effective liquidity risk management involves maintaining a buffer of high-quality liquid assets, stress testing for various scenarios, and establishing contingency funding plans. Operational risk arises from the failure of internal processes, systems, or people, or from external events. This type of risk encompasses a wide range of issues, including fraud, legal risks, and cyber attacks. The infamous rogue trading incident at Société Générale in 2008, where trader Jérôme Kerviel incurred losses of €4.9 billion, highlights the potential impact of operational risk. Organizations can manage operational risk through robust internal controls, regular audits, employee training, and the implementation of comprehensive risk management frameworks. Interest rate risk is the risk that changes in interest rates will adversely affect the value of an investment. This risk is particularly relevant for fixed income securities such as bonds. When interest rates rise, the value of existing bonds typically falls, and vice versa. The Federal Reserve's interest rate hikes can have significant implications for bond prices and overall market conditions. Interest rate risk can be managed through duration analysis, interest rate swaps, and diversification across different maturities and interest rate environments. Currency risk, also known as exchange rate risk, arises from fluctuations in the value of currencies. This risk is particularly pertinent for multinational corporations and investors with foreign investments. For example, a U.S. investor holding European stocks will face currency risk if the euro depreciates against the dollar. Currency risk can be mitigated through hedging techniques such as forward contracts, options, and currency swaps. To effectively manage these various types of risks, financial markets rely on a range of risk management theories and tools. Modern portfolio theory, developed by Harry Markowitz, is a cornerstone of investment risk management. MPT emphasizes the benefits of diversification in reducing unsystematic risk and optimizing the risk-return trade-off. According to MPT, an investor can construct an efficient frontier of optimal portfolios that offer the maximum expected return for a given level of risk. The capital asset pricing model, developed by William Sharpe, builds on MPT by introducing the concept of systematic risk and the beta coefficient. CAPM posits that the expected return of an investment is a function of its beta, which measures its sensitivity to market movements, and the risk-free rate plus a risk premium. CAPM provides a framework for pricing risky securities and assessing the expected return on an investment given its risk. Value at risk is another widely used risk management tool that quantifies the potential loss in value of a portfolio over a specified time period and confidence level. VR is particularly useful for measuring market risk and is a standard metric used by financial institutions for regulatory reporting and internal risk management. However, VR has its limitations, including its inability to predict extreme events and its reliance on historical data. Stress testing and scenario analysis are critical components of risk management that involve evaluating the impact of extreme but plausible events on a portfolio or financial institution. These techniques help identify vulnerabilities and assess the resilience of an entity to adverse conditions. The Dodd-Frank Act stress test and the Comprehensive Capital Analysis and Review are regulatory frameworks in the United States that mandate stress testing for large financial institutions to ensure their stability and robustness under severe economic scenarios. The integration of risk management into strategic financial planning requires a comprehensive understanding of financial indicators and metrics. Key financial indicators, such as the Sharpe ratio, Trainer ratio, and Jensen's alpha, provide insights into the risk-adjusted performance of investments. The Sharpe ratio measures the excess return per unit of risk, while the Trainer ratio assesses the return relative to systematic risk. Jensen's alpha evaluates the performance of a portfolio relative to its expected return based on CAPM, providing a measure of a manager's skill in generating excess returns. Effective risk management also involves the use of derivatives and other financial instruments to hedge against potential losses. Options, futures, and swaps are commonly used derivatives that provide flexibility in managing various types of risks. For instance, interest rate swaps allow entities to exchange fixed and floating interest rate payments, thereby managing interest rate risk. Similarly, currency options provide protection against adverse currency movements, enabling firms to stabilize their cash flows and earnings. Risk management is an ongoing process that requires continuous monitoring, assessment, and adaptation to changing market conditions. The dynamic nature of financial markets necessitates a proactive approach to risk management, incorporating both quantitative and qualitative methods. Advanced statistical techniques, such as Monte Carlo simulations and copula models, provide sophisticated tools for modeling and assessing risk. Additionally, qualitative assessments, including expert judgment and scenario planning, offer valuable insights into potential risks that may not be captured by quantitative models. In conclusion, understanding risk in financial markets is a critical aspect of strategic financial planning. By comprehensively analyzing the various types of risks, their sources, and the methods used to mitigate them, investors and financial institutions can make informed decisions and align their investment strategies with their business goals. The application of risk management theories and tools, coupled with continuous monitoring and adaptation, ensures the resilience and stability of financial entities in an ever-evolving market landscape. The integration of financial indicators and risk management practices into strategic planning enables organizations to navigate uncertainties and achieve long-term success. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.